As the weekend settles in, the U.S. markets are quiet, and trading for SoFi Technologies Inc. is paused. The stock closed its most recent session on Friday, October 3, 2025, at a price of $25.24. This represented a notable downward move, shedding $0.73, which translates to a 2.81% drop for the day. Now, on the surface, a nearly 3% slide for a high-growth fintech name like SoFi might seem like just another day of the volatility we've come to expect in this sector. Many investors using platforms from Fidelity to the Robinhood app might simply shrug this off, attributing it to market noise or a slight sector-wide pullback. But that interpretation misses a critical undercurrent that is beginning to take shape. This isn't just random volatility. That 2.81% decline on a higher-than-average trading volume points to a much deeper, more sober reevaluation of SoFi's core narrative by the larger, more influential players in the market. The kind of sophisticated investors who rely on professional-grade tools like those offered by interactive brokers for their analysis. The prevailing expectation, the story that has propelled SoFi stock for the better part of 2 years, is one of inevitable dominance. The narrative goes something like this: SoFi is not just a digital lender, it's the future of banking, an all-in-one financial super app destined to capture the hearts and wallets of the younger generations. With its coveted national bank charter, it has a structural advantage, allowing it to gather low-cost deposits and fund its own loans, setting it apart from its fintech peers. This is the story that fuels much of the discussion about online investing and makes SoFi a staple in many a self-investing portfolio. The belief is that its flywheel model, where a customer comes in for one product, like a student loan, and is then cross-sold on SoFi Invest, a checking account, or a credit card, will create an unstoppable engine for growth and eventually immense profitability. It's a powerful and appealing vision, one that suggests a clear path to becoming a financial titan, perhaps one day even mentioned in the same breath as today's tech giants like Apple stock or Nvidia stock. However, the reality digging beneath that polished surface reveals a far more complicated and challenging picture. The market is beginning to question the cost of that vision. While the bank charter is undoubtedly a powerful asset, the truth is that customer acquisition in the financial services space is brutally expensive. SoFi pours enormous sums into marketing to attract each new member, and the central question that institutional capital is now asking is whether the lifetime value of these members truly justifies the escalating acquisition cost. In a high-interest rate environment, the risk associated with its lending book, particularly personal loans, becomes magnified. The expectation is a seamless, frictionless super app. The reality is a capital-intensive lending business finely balanced against the promise of a high-tech platform. That 2.81% drop isn't just a number. It's a symptom of the market's growing impatience and its demand for proof that the flywheel isn't just spinning, but that it's actually generating sustainable, profitable momentum. Let's dissect the recent price action more closely. The trading session that ended at $25.24 was marked by a significant volume of over 78 million shares. This is considerably higher than its daily average, and high volume on a down day is a classic indicator of institutional distribution. This suggests that large funds, the ones that manage Fidelity wealth management accounts or build complex Schwab Intelligent portfolios, may be trimming their positions. Recent 13F filings provide a mixed but telling picture. While some funds have initiated or added to their SoFi stock positions, others, particularly those with a more value-oriented approach, have started to reduce their exposure. They see the high price-to-earnings ratio and the continued reliance on stock-based compensation as red flags in an economic climate that favors tangible profits over speculative growth narratives. This institutional skepticism is a direct counterweight to the often enthusiastic retail sentiment found among users of platforms that offer SoFi Investing and Robinhood stock trading. The professionals are looking at the balance sheet, the credit quality of the loan portfolio, and the net interest margin compression, while many individual investors are still captivated by the top-line member growth figures. Furthermore, we cannot analyze SoFi in a vacuum. The broader macroeconomic environment is acting as a significant headwind. The Federal Reserve's stance on interest rates is the single most important variable for SoFi's business. Higher rates can boost their net interest income, but they also significantly increase the risk of defaults across their loan book. Consumer credit card debt is at an all-time high, and savings rates are dwindling. This is a precarious setup for a business whose bread and butter is still lending. If the economy tips into a recession, the default rates on those unsecured personal loans, a major growth driver for SoFi, could spike dramatically, putting severe pressure on their earnings. This is a fundamental risk that the market is starting to price in more aggressively. The expectation was that SoFi's tech platform and diversified services would insulate it from the cyclical nature of lending. The reality is that the lending segment remains the dominant engine of its financial performance, making it highly susceptible to economic downturns. This is a detail that requires more than just a glance at a mobile trading app. It demands a deeper look at economic indicators, something that is standard practice for users of advanced trading platforms like interactive brokers. Now, to be clear, this is not to dismiss the very real progress the company has made. SoFi's business is structured around three core segments. First, the lending segment, which includes student loans, personal loans, and home loans, remains its largest revenue generator. Second is the technology platform, primarily comprised of Galileo, a payment processing and API platform that services many other fintech companies. This segment is crucial as it provides a non-lending, high-margin revenue stream. Third is the financial segment, which houses SoFi Money, SoFi Invest, SoFi Credit Card, and other products. This is the part of the business meant to create the sticky ecosystem, the flywheel. The company's execution has been strong, consistently beating analyst expectations on both revenue and earnings per share in recent quarters. Member growth continues to be robust, and the cross-buying of products is increasing, showing that the flywheel concept has merit. The last earnings report highlighted this continued top-line growth and offered guidance that projects a path towards sustained GAAP profitability, a milestone the market is desperately waiting for. The introduction of new features, such as the recently launched options trading on the SoFi trading platform, also aims to increase user engagement and revenue per member. However, the risks are equally substantial and cannot be ignored. The most immediate risk is a credit event. An unexpected spike in delinquencies and defaults would be devastating for the stock. Competition is also relentless. SoFi is not just competing with other fintechs, it's competing with the entire banking establishment, from JP Chase to Bank of America, all of which are pouring billions into their own digital offerings. There's also the persistent issue of stock-based compensation, which dilutes shareholder value even as the company reports non-GAAP profits. This is a critical point for anyone doing serious investment help or self-investing. Looking past the adjusted numbers is essential. The expectation is that SoFi's tech edge gives it an insurmountable moat. The reality is that its moat is constantly under assault from all sides, and its success hinges on flawless execution and a favorable economic backdrop. Comment below, what do you see as the single biggest risk to SoFi's business model over the next 24 months? In summary, the story of SoFi Technologies is a classic example of market expectations colliding with a more complex operational reality. The 2.81% drop that capped the last trading week was more than just noise. It was a reflection of this growing tension. The market's initial belief was in a seamless fintech disruptor that would effortlessly reshape the financial landscape. The deeper analysis reveals a company that is, at its core, a bank, subject to all the traditional risks of credit cycles and economic sensitivity, albeit one with a powerful technology platform and a strong brand. The path forward for SoFi is not the smooth, upward-sloping line that many had hoped for. It will be a battle fought on multiple fronts, managing credit quality, fending off intense competition, and proving to a skeptical market that its expensive growth strategy can turn into sustainable, long-term profitability. The narrative is compelling, but the numbers on the balance sheet and the clouds on the economic horizon will ultimately determine whether reality can ever live up to the extraordinary expectations. If you enjoyed this video, smash that like button. Don't forget to subscribe for more awesome updates. Hit the bell icon so you never miss a notification. Disclaimer: this content is for educational purposes only. I'm not giving any investment advice. Please do your own research and consult a financial professional before making decisions.